Good day, everyone. I'm Mary Natividad, and I'm going to discuss about the financial side of product management. Product managers need to establish a framework of financial plans, budgets, and controls related to their products, services, and customers to be able to make sound decisions. General cost classifications. In manufactured product environments, there are two major cost classifications, manufacturing and non-manufacturing, each of which has simplifications. So I will discuss about manufacturing and non-manufacturing later. So let us proceed first about manufacturing cost. Include all those related to the transformation of raw materials into final products, including direct materials, direct labor, and manufacturing overhead. Manufacturing costs play an important part in the successful design and manufacture of a product. First, direct materials, such as wood in tables and steel in cars, become an integral part of the finished product and can be considered direct cost. For example, the direct material of a baseball bat is the wood. Flour, sugar, and vegetable oil are direct materials of a company that manufactures dessert products. Second is direct labor. Includes the labor directly traceable to the creation of products. Research and development, support staff time, and other labor not directly related to manufacturing are included in indirect labor. Some examples of direct labor include quality control engineers, assembly line workers, production managers, and delivery truck drivers. Next, third, manufacturing overhead. Includes all costs of manufacturing, excluding the direct material and direct labor costs described above. Included in this category are items such as indirect material, indirect labor, heat, light, and depreciation. The examples of factory overhead costs are production supervisor salaries, quality assurance salaries, and materials management salaries, and so on. So let's proceed about non-manufacturing costs. Include the marketing, sales, administrative, and support costs unrelated to the production of products. So these costs are not needed in transforming materials into finished goods. Non-manufacturing costs include selling expenses and general expenses. Selling expenses, also called selling and distribution expenses. Next is marketing and selling costs. Include advertising, shipping, sales commission, and salaries. Examples of costs that are classified as marketing expenses are advertising, agency fees, customer service, and so on. So the purpose of selling costs is to influence the demand curve for the product of a firm or group. Next is administrative expenses. Include executive, organizational, and clerical salaries. Typical items listed as general and administrative expenses include rent, utilities, insurance, executives' wages, and benefits. So, administrative expenses appear below cost of goods sold and may be shown as an aggregate with other expenses such as general or selling expenses. So, both manufacturing and non-manufacturing costs result from the normal operation of a business. Next is the income statement. Resulting from the above process of listing costs provides a historical review of the results of operations. It does not necessarily provide information for planning and improving the decision-making process of product management. So this is the simplified income statement. It includes sales, gross profit, net income from operations, net income before taxes, and net income. Sales is cost of goods sold. A sale is a transaction between two or more parties in which the buyer receives tangible or intangible goods, services, or assets in exchange for money. Next is gross profit. Operating expenses. You can find the gross profit by subtracting the cost of goods sold from the revenue. For example, if a company had $10,000 in revenue and $4,000 in COGS, the gross profit would be $6,000. Next is net income from operations. Other income. Other income is income that does not come from a company's main business, such as interest. Examples of other income include income from interest, rent, and gains resulting from the sale of fixed assets. Other expenses. Other expenses are expenses that not relate to a company's main business. As well as operating costs, the company needs to consider other expenses including interest expense and losses from disposing of fixed assets. Examples of other expenses include interest expense and losses from disposing of fixed assets. Next is net income before taxes. Profit before tax is used to identify how much tax a company owes. Profit before tax can also be a profitability measure that provides for greater comparability among companies that pay a varying amount of taxes. Last is net income. Net income is the result of all costs, including interest expense for outstanding debt, taxes, and any one-off items, such as the sale of an asset or division. And it is important because it shows a company's profit for the period when taking into account all aspects of the business. Next is concepts of segmented reporting. Variable costs are those that vary in direct relation to the activity level. If activity level doubles, variable costs double in total. Variable costs vary based on the amount of output produced. Variable costs may include labor, commissions, and raw materials. Fixed costs remain the same regardless of production output. Fixed costs may include lease and rental payments, insurance, and interest payments. The example of variable costs are piece rate labor, production supplies, billable staff wages, commissions, credit card fees, and freight out. So direct materials and direct labor are variable production costs, and sales commissions represent a variable sales expense. The last is fixed cost. On the other hand, do not change regardless of changes in the level of activity. So the most significant benefit of fixed costs is they are easy to budget. You know over each period what this cost will be, and you don't need to make any budget accommodations if production increases suddenly. So I have some example of fixed costs: amortization, depreciation, insurance, and interest expense.